Awesome. On behalf of Booth, thank you for coming to today's conference. Today we have the Transitioning Legacy panel. The inspiration for this panel was really around how do you think about transitioning legacy with a closely held business or with a family-owned business pre and post deal. And so today we have a wonderful panel of people with experiences all across the board. And so with that, I will introduce our moderator, Kevin here, and then we'll have approximately about 45 minutes of the panel, and then we'll have a Q&A for the final 15 minutes. All right, so just really quickly for Kevin. Kevin is the Senior VP and Director of Search Fund Lending at BankProv. Kevin has more than 20 years of commercial banking experience with the specialty working with search funds, private equity, and individual family office investors on cash flow M&A transactions. Before joining BankProv, Kevin spent 7 years at regional banks financing lower middle market businesses under $100 million in revenues, 7 years at Bank of America in their global corporate banking group, financing mid and large cap tech companies, and 4 years at Citizens Bank. He earned an undergraduate degree from the University of Massachusetts, Amherst, and an MBA from Babson with a magna cum laude distinction. All right, I'm going to pass it off to Kevin here.
Thank you very much, Andrew. Can you guys hear me okay? Okay, good. All right, so we're just going to go down the list here. Thank you very much for all being here. We're going to be doing Transitioning Legacy. We have 3 great panelists here, and they're going to just do a quick bio of themselves. So, Tim, why don't we start with you?
Sure. So I'm Tim O'Donnell, class of 2018 at Chicago Booth. I launched the search in middle of 2019, right before COVID. Perfect timing, right? Spent about 2 years searching, and then was lucky enough to come across 2 environmental testing laboratories. One which was called Stat Analysis, which is located near Rush Hospital, downtown Chicago, and one that was called EMT, which is in Des Plaines near O'Hare. We rebranded as Sterling Labs, and we're currently operating out of those 2 facilities.
Good morning, Mary Josephs. It's a pleasure to be here again. I'm founder and CEO of Verit Advisors, a boutique investment bank. We specialize 100% in corporate finance and advisory services and consulting around employee ownership, or ESOPs. I am an '89 grad from Booth and have spent my career in banking and investment banking, middle market M&A, and my own firm.
Good morning, everyone. It's a pleasure to be here. I'm Toby Chang. I'm currently investing with the Relay team, Relay Investments. For the purpose of this conversation, a lot of the experience comes from my own experience as a searcher operator. So raised a partner search back in 2014, acquired a IT managed service business in 2017, and was operating that for the better part of 4 or 5 years. In that business, we still own it with our investor group. My partner runs that as full-time. But for a little bit of context as well, with that transaction, the seller's son was running the business as president for a number of years. And so there is kind of a multi-year or multi-generation kind of transition that we work through as well in our experience.
Thank you very much, guys. So for the purpose of this panel, we are going to do both talk about some of the pre-transaction hurdles and obstacles you have to deal with, as well as the post-transaction hurdles and obstacles you have to deal with. We're going to leave about 10 or 15 minutes for questions, so we will have that open. So, Tim, I'm going to start off, and this question is initially going to be for you.
Sure.
When you're doing a deal and you're buying a company, there's obviously, it's a competitive process. A lot of people here probably already know that. You're trying to establish credibility with the seller that you're buying this company. Like, how do you go during the process to establish that credibility? And during your process, and this is going to be a theme, what are things that you might have done well, and maybe what are some things you maybe didn't do well?
Yeah, I'd say there's a lot of learning lessons in a search. So there's a lot that I didn't do well, but I made sure I learned from them. So what I would say in the process, though, when I got the hang of things, what I focused on was making sure that the seller felt comfortable, that I knew what I was doing. You know, I wasn't pretending to know the industry. I'm not a chemist by heart. I'm never going to be a chemist. But I could let him know that, hey, I know how to operate a business. This is generally how things should be done. And ask questions about the organization and stuff like that. But I focus mainly on, I can get this deal done, right? Here's the deal timeline. You know, and the one thing I can promise is that we're not going to hit that timeline. And just being upfront about that, right? I'm not perfect. No deal's perfect. We're going to hit road bumps, but I want to see this thing happen. So that's what I thought really took traction. what I learned is when I started my search, I had a private equity background. So I kind of thought I knew what I was doing, right? That's not the case in the search. Everybody comes to you with a deal in private equity. In the search, you're going to people, and people like talking. And I think I talked way too much when I started, talking about me, talking about my background, and they just don't really care to a certain extent. They care that you can get the deal done and that you like the business. So I'd say that was my biggest learning lesson, was talking too much and not listening.
So on that note also, like, especially when you're doing that and you're dealing with scientists, especially chemists and PhDs, and you're not one, and you're buying a company that is a specialty on that, like any hurdles or obstacles you have to do, because that seems like it's, you're having to sell a lot of people that have very high technical degrees.
Yeah, so, obviously I had to sell the seller on my capability to buy the business. It's a whole different aspect to sell the employees that I'm capable of running the business. And I definitely did have, especially on the stat acquisition, someone that thought would own the company. And so convincing him that I could run this company and that we could work together. I think coming at it just from a humble perspective and saying, hey, I don't know this stuff, and I'm willing to spend the next 6 months focused on learning this stuff, and I'm going to spend the rest of my time here making sure that I continuously learn.
Thank you. So, Toby, we're going to kind of go over to you now. So, along the same lines of the question that we just asked Tim, are there any differences? You deal a lot with SaaS companies, which is obviously a very popular search space right now. You deal a lot with managed services companies. I've done a lot of those deals myself. Any differences in those worlds as far as when you're establishing credibility, buying these companies, trying to convince them that you can do the deal, and any maybe mistakes that you've made along the way?
Yeah, so I think, maybe taking a step back and just like my thoughts on kind of establishing that credibility when you're engaging with the seller. I really like the title of this session, which is Transitioning Legacy. And I think part of the perspective I bring is, in order for you to transition legacy, you have to start with actually understanding what that legacy is. And so the two words that come to mind for me is curiosity and being a good listener, or like call it two themes, right? So I think through the process, a lot of what we end up getting to the point is really spending a lot of time with the sellers, like outside of the formal kind of diligence calls where you have like a lot of back and forth Q&A, but kind of in more of the informal one-on-one time, if it's over lunch or dinner, really just spending time to ask the seller about their story. Back to the point, like a lot of the sellers like to tell their stories, right? That's so much of the experience is you burn tons of time when the seller's just telling you a story and it's really not the right business for you. But when it is the right business, you want to be able to kind of create that safe space to learn about the history of the business. Like, what does the seller really feel were the pivotal moments? How were those decisions made? What were the tough times that they lived through? And I think that's what helps build that connection when ultimately, if your value proposition relative to a private equity buyer is you're going to preserve you're going to transition their legacy, you're going to take care of their baby, asking those questions, creating time for that ultimately shows that you care. So that, again, like be curious, ask lots of questions about the history, and then be a really good listener, because you'll be surprised how much of the little kind of notes and insights that you pick up from those stories that really speak to the culture of the business, which helps call it post-acquisition, and I know we'll get to that. So on those two, then when I think of my own experience coming into a technology business, and maybe where that might be a little bit different, Tim, from your experience, was when you think of investing into technology or stepping into a technology business, just know that technology evolves very quickly. And I think that's one of the perspectives when you're asking about the history is understand how the business has evolved with all those technology shifts, and then really get a sense and flavor of how involved was the seller in adapting to those, or was it like kind of him or her relying on the broader team, and having that as a particular element of kind of that line of questioning.
Because when you're in your world, I mean, the SaaS it moves a million miles a second, right? And so you're having to not only convince the seller that you have a good mission and good plan going forward, because this seller obviously is important and he's not just collecting a check for him, it's a business that he's trying to, and then how do you convince him that you are going to be able to stay abreast of the technology for the next 2-3 years? And part of the storytelling is then understanding how much was this one individual, call it the owner, driving all those decisions, how much was he relying on a team, is there a good product team around him,
How was that? How were those decisions made? Like that ultimately helps also as part of the diligence, really allows the searcher to understand how much reliance is there on the seller. Is there over-reliance on the seller to really run the business?
All right. Now, Mary, I'm going to have, because I know you do a lot in the ESOP world. And so the ESOP world, I mean, we all have a lot of experience in the traditional side and the self-funded side. The ESOP world isn't one that we probably dabble in too much to some extent. So I feel like that's a kind of an interesting, could you kind of go into a little bit of that world and then how that would kind of fit into the same equation? Is it similar to how we, or is it, is a little difference to it?
Sure. Toby, when you were telling your story, I recall a transaction where the business owner called me up and killed it at the 12th hour. And I said, why? And he said, because the 24-year-old guy from New York representing the private equity firm was taking other calls in my courtyard, and I knew he didn't care about my business. So that really resonated for me when you said that. Private business owners care deeply about their business, and I resonate with what was said here, how important it is to understand the business owner. ESOPs are a quirky tool that can be used. I would first use the tool as a hack to accelerate that conversation that Tim and Toby just talked about, how to get to trust. It's much easier to have a conversation about staying in the business, rewarding your employees, and not paying federal income taxes than it is to have a conversation about selling your baby. Now, by advancing into it through the ESOP vehicle, if you will, into that conversation, once you learn their objectives, there's a 90% chance that the ESOP's not the right tool, and you already have that deeper relationship with that particular entrepreneur. Where ESOPs are most pervasive with the ETA world right now is twofold. One is as an entree to maybe get more hits or deeper conversations from your searches, which congratulations to all of you, that searching is tireless. The second is a real growing field right now of combining broad-based ownership alongside private equity. I think where you'll find the most information about this is through a nonprofit called Ownership Works that was started by Pete Stavros, who heads private equity for KKR, and his colleagues, and is now, when you look at the sponsorship page, sponsored by all the major private equity firms and financial institutions across the country. So what the theory is that if you share between 5 or 10% in some form of the growth of the company, that you get more engagement from those employees, you have lower turnover, higher productivity, cost savings, and ultimately better returns for your investors.
So I'm going to do a follow-up question and put you a little bit on the spot. I would say in that world, if things are going up in the right direction, I would imagine the engagement is probably pretty good, right? What if things are maybe going a little bit bump in the night and then it's going the wrong direction? Then all of a sudden these employees are, seeing their share or their value go down. Like, how do you handle maybe those situations?
It's a great question. So statistically, over the 30 years that ESOPs have been in place, ESOP companies outperform their peer group on average 10% top and bottom line. What KKR, who's been measuring the 35 transactions that they put this sliver into, is they've had extraordinary returns for investors, and in fact are finding institutional investors willing to take a lower cost of capital to market risk. So why is that? Sure, things can go bump in the night. Look at the unforeseen surprises we've had recently from the rising interest rates, the war in Ukraine, supply chain issues, and now what's happening in the Middle East. So no company is immune from those surprises. What we see when there's a level of employee engagement, which includes some sort of participative sharing, and what you're talking about with leadership and culture, that when there's a surprise, you see that the team banding together, and examples could include organized work furloughs, more ideas on cost cutting, more ideas on efficiency, repositioning team members from marketing and events to research and development and such, and they tend to have a much higher resiliency than that average company.
Oh, thank you. It's important because obviously the buy-in from the employees on an ESOP is almost, it's always important, but it's certainly got a different importance to it. Tim, this question is for you.
Sure.
So you've taken the deal, you've gotten the transaction, the seller really likes you, and then the seller becomes a little too engaged. How do you maybe make that split from, okay, it's my business and the employees have to follow me, versus going and, are you running to the same person? I mean, how do you make that split, and is there any problems, or did you have any issues when you did that?
Yeah, so, I'd say there's no one size fits all, right? So the easy transaction for me was EMT. Mike Gower, the former business owner, he was done. He just kind of wanted to ride off into the sunset. And so he stayed for about 9 months and was really just staying as a subject matter expert for wastewater monitoring. He actually taught me some chemistry.
Okay.
On the stat side, and we knew this going in, which is part of the diligence process, is knowing what kind of personalities you're dealing with. Dr. Kumar has a very strong personality and has a very short fuse. And so that led to a pretty negative culture at Stat. And so the focus there was for me to build that relationship with him over the first few months and then assess where he probably fits. My learning lesson is that I probably should have already known I've already done the assessment and not wasted those few months. But essentially, he was in the management meetings originally. He would be making statements in the management meetings, which I would not want him making those statements. He was trying to drive sales that really didn't make any sense. And so I did have a sit-down conversation with him where I didn't talk about what he's doing wrong. I kind of focused on what he's doing right, talking to prospective customers, and created a new role for him that basically got him out of the day-to-day with employees, so that wouldn't be an issue anymore. And he was no longer talking to current customers. So that essentially solved my problem there.
All right. So along the same lines, because you said you worked with your family individual for a long time with the company, like any situations that you had where it was hard to make that break? And, I'm going to kind of tweak it a little bit. If you were buying the company and you were looking at that, are there any red flags that might steer you away from buying a company if you thought that break was going to be difficult?
Yeah, so I think one of the things that we did well, certainly, I believe, is manage that transition. And so maybe just a little bit of color on tactically what we did. And again, the context was the seller or the founder of the business. His son was basically kind of grew up in the business and was acting president for 5 years before we acquired. And so we were in our early 30s when we bought the business. He was kind of 10 years our senior, so still generally pretty young, and wanted to stay involved. But the thing that we were very intentional was kind of through the diligence period, we actually, by the time we were ready to announce the deal, we had already very clearly defined what the org structure was going to look like. And so I had my scope of responsibilities, my partner had his, and call it the former president, we had defined a scope, and it was obviously taken down from what his role was as president. And when we transitioned to the business, we shared what that org structure was going to look like. The communication to the team was that on day one, nothing does change, because myself and my partner, we would shadow the president, but then we would come back to everyone to say, hey, at a certain date, we're basically going to change who the decision maker is for those functional areas, right? So where I had responsibility for operations, my first 30 days, I was shadowing whenever he had a meeting, operations related with a team member, I would shadow that. And then we got to the point where we told all the managers, hey, as of this date, Toby is now the decision maker. But everyone knew that Robert, the former president, was behind the scenes. And so we were very clear in setting kind of an expectation with the broader team of when that decision-making transition would happen. And so I think to your second point, which is, things that maybe would be flags to really stay away from, to me is if the seller is if there's very, very high reliance on the seller, that's where I think there's a lot of work to be done to work with your investor group to kind of brainstorm around, is this something that can actually be mitigated? And if not, I think that's something that you step away from. And if it's conversations are gearing towards, hey, searcher, I'm coming in as CEO and you continue on as president, I think there's a lot of dangers around that type of setup.
And when you made that break, employees were all bought in? I mean, was there any issues, or was it a process that maybe took 3 to 6 months for people to actually buy into it?
So that was, again, fortunately for us, I think that was a transition that worked out very well. Where things didn't go to plan and things never go to plan was we did rely on the seller to take on certain functions, and then it became very clear, even within the first 6 months, that he wasn't going to call it, perform at the level we wanted.
Okay.
So then it was a systematic kind of take down his responsibilities
Okay.
over what was 2-year period.
Okay. Mary, this question is for you. I know we've got Tim and Toby have been, one is in the search, one is running a company, one has run and sold a company. Are there any personal or psychological issues or any let's just say things that do not show on the QV, that do not show on the SIM, like any other factors that you would look and just say, I'm not really interested in that?
This is an outstanding question. You all here and each of us spent a lot of time enhancing our education, maybe at Chicago Booth or Northwestern Kellogg. But the most important is the EQ and the things that aren't on that spreadsheet. Number one is integrity of the financial statements, and not just the Q of E integrity, sort of the attitude within the organization of, I'm thinking of your leader from the second firm there. Sometimes when there's a lot of fear, there's within an organization from a leadership style, you can relax into this habit of just not reporting bad news because of the culture within the organization. So understanding that, we were in a situation where the CFO, the CEO was incredibly caustic and had a throw people under the bus attitude, and the CFO was on the verge of a nervous breakdown, and that's when you walk.
Yeah. It kind of goes to what Graham was saying in the keynote speaker in the morning, where there was two things he said that I thought were good. The first thing was buy a company that excites you, which, it's you're going to have suffering and there's going to be down periods. So there's got to be something that interests other than just flipping it. And the second is there's going to be pain and there's going to be valleys along the way that you have to deal with. So as part of this, I'm going to kind of flip a little bit, and I'm going to start moving into the post because I know we're running up a little bit against the time. So we have bought the company. The sellers are excited. You've separated from the sellers. We have now gotten the companies, the employees to buy into you. Tim, I'm going to start with you on this one because you are buying a company where there's a lot of experience that you don't have, specifically in the chemistry market. So when you're filling your management team and you're filling specifically your board seats, how much time and thought are you going into, how are you filling those seats and making sure that it complements the experience that I don't have? I a little bit of a self-reflection, I don't know it all, so I need to make sure I have people who do.
I think that's the one thing I realized coming into Stat and EMT right away. Yeah, I don't know everything, and I probably don't know more than half the employees in that building, right? But with the employee base specifically, it was important. And I think it was discussed earlier, is just seeking to understand, right? I'm seeking to understand, I want to learn, and I want to be able to connect with the employees. And then once I understand that, I'll know what the weaknesses are and what we need to fill. What we ended up doing, because we do have a pretty large technical team, we started to reallocate different positions to different roles. There's certain people that really didn't have management capabilities, but they're very technical. So put them in that role and put a manager in the managerial position, right? So that's what happened there. With the board, I was focused on, I wanted half the board to have the experience with lenders. So I have BankProv, and we have a really good relationship there too. So
thank you for the plug, by the way. Yeah, appreciate that.
Elliot took some pictures earlier. Anyway, I have 2 investor-based board members that can talk the financials, that can talk about their past experiences with a plethora of businesses. But then I also have 2 board members that are former searchers and former operators. And it's kind of funny, I'll be in a meeting and we'll talk about the financials, and Carlos and Scott will lean in a little bit more there. But when we talk about the offsite and talk about the core values we developed, Mark and Chris get excited. So it's kind of nice to have that dynamic.
I'm actually going to ask, when through the deal-making process or the diligence process did you really start concentrating on forming that board? What was your experience? Sorry, I'm taking this over.
That's a great question.
Not early enough.
Okay.
I don't think it's ever early enough. I would even start thinking about it before you launch a search. It was probably around the time I started drafting my sim. So, the intention was to close about a month after that. It did take longer.
Okay.
But that is a process. A lot of investors are capacity constrained to be on boards. And so it is something that's pretty important. And I would make that top of mind once you sign an LOI and after you've spent the 2 or 3 weeks to make sure it is the deal that you want to close.
And that was a great question because, that was one of the things that and share your experiences because, you're talking about individuals who obviously have high degrees, very smart, but okay, I need 2 really good finance guys. Okay, that might be a little bit on the easier side, but then I have to find 2 really savvy PhDs or technology. That's not, it's easier said than done. How did you do that in your process in the SaaS and the managed services world to make sure you're filling out a board? And how early did you do it? Are you doing this after you buy the company, or do you know well before, like you kind of know who you're going to be bringing in?
So we did add an additional board member within the first 12 months, and we kind of had that lens of we had some good support as we were going into the first early phase of transition. A big caveat is I have a very non-traditional investor group.
Yeah.
So I think what's more helpful here is maybe sharing kind of some of my observations being in the relay seat now. And I think I would probably echo, Tim, kind of what you're saying is like it's never too early. Really, it's part of the whole thought process when you're building your cap table. And really for the seats that you would think of reserving for investors or kind of the searcher operator experience to bring onto the board, like that's part of the journey throughout the entire search. And often when you're fundraising and when you're firming up your cap table, you have a sense of who has capacity, but something to keep in mind is that changes over time as well. And so I think one of the cautions is, searchers will work with lead investors like a relay to make sure we're staying in touch, and the lead investors often will have space, but for call it the smaller investors, their capacity for boards might evolve over a 12, 18, 24-month period. So it's important to still have those, quarterly check-ins with them to get a pulse of like what is the availability amongst your investor group.
Can I add on to that for 1 second?
Please.
So one of my board members was recommended to me by search fund partners. So you can tap on your investor base too and take a board member that has a connection with your investor base but isn't an actual investor. That was super helpful for me too.
And Mary, I'm going to take this to you, but how important is that governance transition? You have a family office or these family companies that, half of them probably have a board that's the seller's uncle, the seller's cousin, his son, and his daughter. And you're going from that situation to a very professional one that's got a finance individual, you've got technical savvy individuals. How hard is that transition? Because you're truly changing not only the makeup of the company, but the makeup of the board is pretty drastic.
And so important, right?
Yeah.
It is drastic, and you kind of understated it a little bit if you're transitioning from a privately held business. I sit on 4 corporate boards, and it has been so much fun to watch over the last decade the evolution of boards with private companies, whereas historically it was unusual to have independent board members. There's so much research out there from the NACD or Women on Boards or other that show the value of bringing independent voices onto the board. What's important is to have a great leader who takes charge and says, this is what we're going to do. I believe in what my colleagues here have said with investors and with sort of industry experts. I kind of call it gap fill. So you did the hard work that Tim did, looking at the organization and then looking at your operating strategy and where do we not have something super strong in the organization? And that's the position that you want to bring on the board. The other aspect of the board that I can't underscore enough is the same thing as the aspect that you're looking at when you look at whether or not there's a fit for the company. There's a chemistry component to it. No, you want to have a culture on your board of respect and teamwork and working towards that common goal. You don't need egos. You don't need ex-executives who are in there telling their war stories of being successful in business 20 years ago. Pay attention to board candidates who are what I would call overboarded, where they don't really have the time or the interest or the passion to really lean into and help you in the way that you do, particularly when you're launching.
So a follow-up question to that, going a little bit off script here, but you filled your board, you think you have this great board, and then you're a year or 6 months into it and the board member's a disaster. Either he's not involved or he's too involved, he's just not a good fit. How do you deal with that?
We heard it in the keynote. We heard it over here that you spent too much time. You have to have the flexibility within your bylaws and charter to remove board members. One strategy that I like a lot is the first time, some companies bring a board member on for an interim period just to test them out, like 6 months before they make them really on the board. And then I'm a big fan of term limits or annual voting and whatnot. It should be understood up front, like you did with your leadership team, that, this isn't a forever position.
Okay. So, Tim, I'm gonna go to you on this one. So when you bought your first company, you were under an LOI to buy your second company. You have, culture on these companies is extremely important. And when you're very young into the process, you're taking two different companies, two different cultures, two different management teams, and then you're trying to then blend them into one company to build the overall value. Can you talk about that as far as how did you blend those two cultures and two teams together? And was it easy, I'm assuming, right?
Jury's still out, I could tell you in about 6 months. Two radically different cultures.
No big deal, right?
Yeah, no. Yeah. Two different cultures. Stat one was pretty poor, so the one in Chicago was pretty poor, but there are a lot of subject matter experts. The O'Hare one, better, but not as much of a sense of urgency as I'd like. So there's kind of a middle ground I want to get at. And the goal here is to physically consolidate at one of the locations. And so what I did was focus on that specific location and make sure that that culture succeeds and make sure that expectations are set in place so that when we absorb the other location, that they essentially need to adhere to those expectations. And then we also have a process to ensure that they do succeed if they want to succeed. So that's why it's still in process, because I think half the business is where it needs to be and half is not.
And how did you go about, let's just say one of the companies has a culture that you love and the other company's culture was maybe less desirable? Like, how do you go about changing the second company's culture to the one that you really like?
I focused on spending time with some of the key people.
Okay.
So there are, I would say, 4 or 5 individuals that, if no one else came from that location, I would still be okay. And so I focused on those 5 individuals to make sure we're on the same page, they feel heard, and they just have their own personality. It's crazy, especially in the kind of techie space.
Yeah.
There's just wild different personalities, and you got to spend time to get on board with them. And then, I have a presence. I'm there 2 days a week. We actually had a conversation with the board because I thought about spending more time at the other location. So I spend an even amount of time at each location. I have monthly check-ins with all of my teams so that there is a presence, they are feeling heard, and if they have issues, I am addressing those issues.
Okay. And Toby, you're working in the SaaS space. It's legendary for culture. You got the ping pong tables. They might come into work, they might not come into work, they might be doing their work at midnight, who knows? How important is culture when you're buying that company to blend into and let's just say your culture is different from the one you're buying. How do you can't really change it too much. How do you kind of deal with that situation?
Yeah, so I think when I think back on my own experience, I kind of go back to this whole idea of understand what that legacy was, right? And in a way, while it is kind of SaaS and technology, the culture that we stepped into was one of, it's a very big family feel. And to I think your experience, it's it's a good, nice family feel, but it's not really the sense of urgency that we all really want to be able to kind of grow and scale the business. And so that's something where, I think we took the lens of certainly do no harm in those first 6 to 12 months. Kind of took our time to really then kind of live out what that culture was that we thought it was based on all the stories that we heard before. But certainly kind of within that 6-month period, we started sprinkling in hey, this is what we want to see a little bit more, and kind of really, in all the town halls, just reinforcing more of the behaviors that we want to see. And then eventually kind of more at a 12-month period, sharing, here are, call it the new established mission, values, culture type of ideas. So that was kind of the first 12 months that we took.
Now, was it, how much of it was, the company had the culture and you had to adapt to the culture, or you had your own idea of a culture and you wanted them to adapt to you? Which one was
I'll kind of go to, I again, like the title of this. I'm looking at the screen here. It's called Transitioning Legacy, right? What we're doing here isn't preserving legacy. We're not just preserving whatever it is that, the seller created. Each of us have our own legacy, and that's what I believe. And when we work with searchers, like, we're trying to understand what their prior experiences and what they're bringing into their search journey. So there's certainly, like, bringing in a new sense of a culture, I think, in a lot of situations.
Okay. And now this question is for you, Mary, and it's more on the board side. Let's say you're on a board, you're sitting there, and you're a year into it, and the searcher, I mean, it's a question no one wants to really ask in this space, but it kind of does need to be asked. I mean, let's say that it's not going well, the searcher's going south. Do you step in? When do you step in? How quickly how do you execute on something like that if you've got some capital in here, and this could be probably asked to any of you, but and things aren't going smoothly. Like, how does that work?
There has to be candid conversations within the boardroom. It's a safe space, and I don't know if you all have read like Crucial Conversations, and that type of coaching is really, really important to have an effective board. So you have to bring it up. You're going to have start by having more regular meetings and check-ins, so that there's clear evidence that we're off of our metrics, and forming a plan with very tight timelines, and then having to take action if necessary. But that is a important question to have the freedom to ask in the boardroom.
And Andrew, I wonder how much, we have about 10, 15 left? 20 minutes? Okay, great. So are there any operational, Tim, this is going to be to you, but can you give an example of when you've been in this company, if there's like operationally, were any issues that were just you found extremely difficult to fix, and how did you go about trying to fix them?
Operational issues that were extremely difficult to fix. Oh my God.
How long do we have?
Yeah, exactly.
Like, how do you, let's just say it's a problem and it's hard to solve. Like, how do you, you're sitting there, you're running the company, you need to look good in front of the board, you need to look good in front of the management teams. How do you go about it?
I could give specific examples. What I would say, though, is that we got to rely on others. And I think that was one of the big talking points. And I think I still hear it from the board, is I try to do too much. And so, understanding that I do have an entire team that knows what they're doing, and being able to get them into a room to problem solve something. So we've had issues in the past where, okay, there's a data issue, right? And the data doesn't look right, but we don't know why it doesn't look right. So we'll create a team to go ahead, and someone's looking at the data, someone else is talking to the analyst, someone else is talking to the customer, and then we're all coming back and coming to our conclusions, and then drafting corrective actions to make sure it never happens again.
All right.
I think maybe my 2 cents on this is, one, you're going into the way to solve that is you got to grind, right? And you, as you talk to more searchers, it's all about the grind, and you have to have that mentality that this is not an easy journey. There's always these operational issues. You have to grind through it. And I think the other, and Tim, you kind of spoke to it, was lean on your board, and you're getting guidance from your board. So often as first-time CEOs, you've never lived this, and it may take you a little bit longer to kind of overcome all these different challenges, but more often than not, you'll be surprised, the board may have seen situations or have experienced it themselves. And so having that network is really important. So leaning on that network starts with the board, because those are the people that you're probably closest to, that's closest to the business. But then think of the network beyond that as well, right? Like, whether it's YPO or you have your own kind of group of other CEOs that you can lean on. Share your experiences with others, and then you'll pick up insights to be able to apply to your own challenges as well.
It all goes according to plan all the time, right?
Exactly.
You set out a projection that's going to grow 5-10% a year, and it just does.
Yeah.
Right? So it kind of
That's what it did in the past. That's certainly what it's going to do in the future.
It kind of gets into why going in, understanding the culture, making sure you have a good relationship with the seller, filling the board seats, filling the management teams are so important, because as you go through these valleys, and they're going to be valleys, leaning on these people to fix the problems is that important.
I'll give you guys a shout out too. Picking the right lender is important too. So
another thank you, Tim.
Actually, I was gonna jump in there on that same topic. Staying in communication with your lender, and that's why I like your relationship model, so that they know when this event happened that you identified it and are taking action.
Yeah. And I think that goes across, I mean, whether it's your management team, your board, or your lenders, or your partners that you're working with. I mean, everyone understands, and we've all been doing this. I mean, I've been doing this 20 years. Most people have been doing this a long time. They know there are going to be valleys. The most important thing is to communicate those so that you at least can understand, okay, this is what we're dealing with, and this is how we're going to fix it, and here's the plan. So I think we've got about 15 minutes or so. We're going to do a question Q&A, but give me, I like to do this. You're sitting at a bar, you're talking with a searcher who's trying to do this. If you had one piece of advice on legacy transition, what would it be? Tim, I'm just going to go from the far end. Tim, why don't you start?
Listen and seek to understand.
Okay. Mary?
Invest the time.
Yeah, building on both those, just understand what that legacy is. Yeah.
Yeah, and I'm going to steal Graham's, pick a company and pick an area that you love, not for the idea of flipping it, but because you actually love it. Because I think when you love something, I think you're going to spend more time on it and you'll be willing to deal with the downs and the lows better. So thank you guys very much. With that said, I want to open it up to the group for questions.
My name is Sadiq Alariwaju. I'm a first year at Booth. Committed to search. I plan to raise in my second year next year. And just want to thank this panel for being here. My question is for Tim. You talked about when you're having challenges in the business, how you maybe need to corral teams that might be a little more technically sound in the subject matter to solve the problem. There's this adage that you're either in the business or on the business, and I think that I'm interested to know how searchers, when they're sourcing deals, should be thinking about the size of the business from an employee perspective to maybe solve for not being the executive who is in the weeds too much and can kind of rely on teams that have that subject matter, or whether that's something that, when it happens, you have to deal with it, but how much can we solve for that in the sourcing phase of the businesses we're looking at?
It's a good question. I would say that's very difficult. At least in my experience, the business owners were very cagey, or they didn't really want me to have one-on-one conversations with their team members. Really all that I thought that I could do, and I'd be interested if there are other opinions here, but all that I could do is take a look at the org chart, take a look at the resumes that I was provided, kind of gather what the seller had to say about his people. And then, really kind of come in and learn. And that's what the first 6 to 9 months really are all about, is understanding if people are in the right places, what deficiencies do we have. But yeah, I don't think there is any silver bullet for that one, unfortunately.
Yeah, I think maybe the other thing to keep in mind when you think of the size and scale, how much resources or bandwidth extra, call it cash, might you have to spend if you're buying $1 million EBITDA business versus 3? Obviously the bigger the scale, you're going to be able to afford kind of more talent to be able to kind of build around you, right? And that's really the big part of the challenge, is you kind of have to grind through, if you're buying a smaller business, to get to that point where you can afford to hire, call it the A players. But I think, again, working with your lenders and understanding how much room to have, I think that's a really important conversation, because you often hear in this space, the more time you spend in it, is we all expect a J curve, right? You're buying these businesses that are the size and scale for a reason. It's they don't have, call it, oftentimes the strength of the management team to be able to kind of get to that scale. And so we certainly had to live a situation where we were continuously investing into the business and live that J. And that's a really important conversation to manage, get alignment with your lenders when you're going into the deal.
Yeah, and from a lender perspective, I mean, that's why when we are dealing with capital structures, I mean, we're not talking about in this panel, but going in with a smart capital structure, I mean, if you're kind of just taking on too much debt, or you're really putting yourself in a jam in the first year, if something goes blip in the night, you can put yourself in a situation within the first 6 months or 12 months that's pretty tough. So I always like it when teams kind of are a little bit more conservative out of the gate, and then they can grow and then utilize that capital down the road as they kind of get a little bit better footing for the company.
Hey, good morning. Hi, my name is Shanor Qureshi. Thanks for joining us. Appreciate your time. My background is I'm a student at Kellogg. I'm an MBA student, and I'm also a product manager. and I'm considering doing a search. So one of the things that I think about when I'm considering leaving the corporate world and moving into something like search is, and I'm curious to hear how much you think this is rooted in reality, is it isolating to kind of be in that position and really thinking about that, right? Because like a lot of people, my job went remote in COVID, and unlike a lot of people, we never had to go back. We just stayed remote, which was fantastic. It was super convenient. But one of the negatives of that is that it isolates you from kind of the work environment, right? So I'm lucky enough, I have Kellogg, I have other social networks that, I don't feel that as much. But one of my fears as I think about ETA is I don't want to go back to that place where I'm just kind of, a little bit more isolated from the broader networks around me. So I was just curious if you could speak to that as well.
I have something to say about that. Being an entrepreneur is isolating. Because you care about decisions. So there's things that you're worried about at night that you can't really go talk to the people at work about. So what I might encourage is building your own mentor, sponsors, advisory board of you, which would be a group of people who you can reach to support you in this journey. And then I would defer to you guys as the search specific.
Yeah, I'd echo the same. It is isolating. I think it's this idea that you're dealing with situations kind of as the owner and CEO that you can't really share with your employee base. So, coming from a larger corporate world where you feel like you really have kind of friends within work, I found it challenging to feel like as much as I want to build connections with my team, it's not that same kind of friend dynamic. And so certainly kind of building on your idea there, it's like, have your peer group. Yes, mentors and coaches for one, but also like fellow CEOs. And that is hard as well because so often than not, there's always things to do. We lived a situation where our heads were in the sand. We're just grinding away at the business. So it was a learning process for us to kind of be able to feel like we can afford to take some time off to kind of build a bit of a community and build a bit of a peer group.
And then I can address while you're in the search. So it's also isolating while you're in the search, unfortunately. There is a network, there is a group, especially in the Chicagoland area, there is a group that, I could meet with once in a while and, bounce ideas off of. But it is very isolating. And, it is one of those things where you see other people getting the promotions, right, that graduated from Booth in the same year as you, and you're kind of questioning what you're doing, right? But if it's really what you want to do, you're going to get to where you need to be, right? And if it's not being a CEO, if that doesn't work out, maybe it's being a COO, maybe it's being a chief of staff, right? So I think it's more of are you ready for the career pivot? And if you are, the isolation, or being a little bit more isolated should be fine.
I'd imagine it's also hard from a rejection standpoint too. I mean, we've all seen the funnel graph, I think. I mean, what is it, like 10,000 emails for like 100 responses, maybe 10 in-person meetings and one deal.
We actually had a Slack channel to talk about like the worst people responses, right? Some people just don't say not interested, all right? So be prepared for that. You're gonna get some nasty responses, but it's all part of the job, it's all part of the search.
Can you hear me? My name is Kelsey Recht. I'm a self-funded searcher out of New York. I have a question for you, Toby. So in the SaaS world, what types of differences in returns and challenges do you see between sort of your typical bootstrapped SaaS company and maybe your VC orphan, just given some of the turmoil in the tech markets right now overall?
So the question is the differences in returns?
Yeah, sort of like what you've seen in the investments that you've done, sort of the pros and cons of both those types of deals in the search SaaS space.
Yeah, so we're in, call it the investor lens with Relay. I'll look to my colleagues and just give me an indication if I'm trending in the right direction here. We haven't invested in any, call it like VC orphans. And so a lot of the typical investments are the company's been around for the 10 plus years, typically bootstrapped, and you are kind of, again, the value proposition is more of this transitioning legacy and not we're just going to kind of take this out of your portfolio and convince the VC group that, that's just a way for them to get liquidity. So can't speak to kind of difference in returns then from that perspective.
I think we have about 5 minutes left, so we have time for maybe one or two more questions.
I appreciate you guys' time. A question for Toby, and a little bit of background. I'm Sean Lee, an operator with Evergreen. You talked about the first year after your acquisition, the company that you acquired maybe lacked a little bit of intensity. After a year, you provided, hey, this is our new culture, these are our new values. Could you talk a little bit more tactically about what you did? Was it certain metrics like utilization that you brought in, certain performance goals? How was it received? Any risks of attrition? Want to understand that whole process.
Yeah, so I never really thought of it as risk of attrition because the lens I took was if people really didn't feel like it was the right fit for them, then it's better that we part ways. A lot of what we did, in my experience, was candidly we did have to replace a lot of people, and so it was kind of systematically understanding like, hey, there's a sequence to you have to kind of remove certain people, kind of bring in the next leader, make sure that they're living out the culture that we really want. Ultimately, a lot of it was numbers driven, right? Like we really kind of believed you can't manage what you don't measure, and surprisingly, as much as we kind of preached that from the get-go, there are certain individuals who really wanted to move in that direction, but they also just kind of hit their ceiling and they couldn't really think of their own KPIs or what really were the right metrics to manage to. And so, those were indications where as much as you could provide some coaching to call it that next layer of management, if it doesn't really work out, then you have to find the right person to bring in.
And I think that also kind of speaks to the J curve as well. When you're buying these companies, inevitably you're going to, have to replace an IT system. The accounting and bookkeeping system might not be good. So therefore there's going to be maybe cost there. You're not expecting a manager or two leaves, which inevitably means you're probably going to have to not only pay a recruiter, but it's going to be more expensive and the salary is going to be more expensive too. So that kind of goes into the margin compression sometimes with these businesses you can see in that first year.
And sorry, maybe the one other thing I'll add is I think one thing that was very important to us was creating a tool or call it a management framework that allowed us to drive alignment. Right, like this was a traditional business or like a legacy business where the seller was just meeting one-on-one with all the team members, and there wasn't really kind of a sense of the team as a collective where we're moving towards. So we adopted OKRs. I know there's like EOS and there's other kind of frameworks, but really kind of implementing that was what's important there is that then you bring transparency to who the performers are and who the underperformers are. And that then becomes very helpful when you do have to make that challenging, the tough decision to say, this person isn't the right person for the team. It becomes more transparent and clear to the rest of the management team. It makes sense. This person hasn't really been able to kind of follow along at the pace and at the clip that we are all kind of working towards. And then, then there's less concern of, this person was let go, like why? At least the management team is following along with that story.
This is for Toby and Tim. My questions kind of center around boards, like you talked about. For those that were not equity investors in your acquisitions, how do you go about compensating them? And then your board meetings, could you maybe speak a little bit to the structure of them, first year versus subsequent years, as the kind of the challenges evolve over time?
I thought they just do it for fun, Yeah, the board member that was not an investor did end up investing a little bit into the deal and then got the same investment, or not the same investment, same kind of like board fee that I pay every other board member. So, it's not a significant amount of cash or anything like that. It was more, this individual operated a very similar business and wanted to be a part of this. So I think it's more vetting that than the compensation side of things. And yeah, he does have a partial investment. I wouldn't call it materially like super sizable, but he is aligned there as well.
Yeah, I would echo that. I think our advice is outside board members should put money into the deal so that there's that alignment. I feel very strongly against, call it, board members earning equity and kind of having that as the payment. There isn't enough skin in the game, so you do have to put a little bit, you need to have the money there to drive that alignment. I think from a call it year one versus kind of year one beyond type of interaction with the board. Often I think within the first year there is at least more of a monthly cadence versus just call it like, the traditional quarterly meeting. And then within the board, there's typically always like, at least one individual that a searcher would lean on maybe a little bit more heavily. And so if it's like weekly check-ins, I think that's more of the norm that we're seeing now. I don't know if in your experience how much that may have evolved as well.
Yeah, I mean, we have a lot going on right now. So we've been doing monthly board calls and then quarterly board meetings. But, there's so much going on that, I might send an email, I might call someone, I might text someone. So the cadence is pretty regular right now.
Yep. And I'll say often that continues beyond 12 months too, right?
I think we probably have time for one more, if I'm correct, Andrew? All right.
Hi, I'm John, first year Boothie. My question is more directed at Tim, but generally anybody. What are some of the challenges? I think most of the people here are quant or quant adjacent, come from environments that are very heavily skewed towards high workers, high achievers, high self-motivated people. How do you manage that transition of your own from that environment into like a work environment where not everybody is as motivated, like intrinsically?
Yeah, I'll take a stab at that first. It's patience. No one's going to adhere to, you're coming in as a CEO and you want everything to work out perfectly. And, can't really set that expectation for everyone. So I think it's, again, going back to the seeking to understand and being patient with people and trying to understand kind of what makes each individual tick. I have examples of specific individuals that, in the first few months, I felt like I had to fire them or, they should quit kind of thing. And now they're probably my biggest champions for what we're doing right now. And they're critical to it and they're totally on board and they're making my life a lot easier. So I guess I'd say it goes back to that seeking to understand and make sure you're evaluating for a while before you start making those tough decisions.
The other reaction I had to the question was, know that, again, leadership starts from the top, and when a new leader comes in, a lot of people are going to look to like, well, what is the culture? What are the patterns of behavior that this new leader will want? And so when we think of like, call it people in this room and the energy that we bring and the drive and the grit and, being able to call it work those late hours, it's important to recognize not everyone can execute at that level, right? When you have kind of the broader team. And so it was actually a bit of learning for me. It's, I asked a lot of questions and I would send emails late at night and, there was a point where I had to step back and be very deliberate in changing kind of how I was engaging with the team to not set that expectation that they all had to perform at that same level.
I learned that too. Yeah. After I sent one of my guys a text at 5 in the morning,
yeah.
I realized that too.
Yeah.
I think across an organization, not every job position needs a high performer. And I think creating a culture where people can be well placed in a job and enjoy the monotony or redundancy of it and do it well and not need to be audited, screened, monitored, that could also be a valuable employee.
Yeah. But I will also build on the earlier question of, is it an isolating experience or not? That also ties into why it's isolating at times, because you don't have the same type of peer group in the day-to-day to be able to kind of bounce the ideas. Yep.
I think we are all done on time. Thank you from all of the panelists here, and very much appreciate you guys listening in.